Yeah, see, the foreclosures has started to kind of come back on the radar. They're not like, I wouldn't say that it become a problem, but they almost were like non-existent for a little while.
Yeah.
Like zero. They were like so few. There were like 9 foreclosures a month, like in San Diego County.
Yeah.
Now we're starting to get back up to the hundreds again. I don't really see it as being necessarily an epidemic yet, but I think what we're just starting to see is when there isn't that many foreclosures for a long enough period of time, it sets up the next wave of foreclosures.
Yeah.
You know, it creates sort of, people start buying who maybe shouldn't be.
Yeah.
And then a year or two down the road, those become foreclosures.
Well, a lot of foreclosures too we're seeing they were loan modifications.
Oh, really?
So they got modified for a 5-year period, but then went back to the original terms. So they got modified in 2012. Now we're in 2017. So.
But I mean, you never have to let the bank foreclose on you.
Exactly.
I mean, there's always an option.
Yeah.
You know, out there, and I think that's, you know, a great thing for us to talk about today. So I'll just kind of cover the credit side of things, you know, as Mr. Credit, you know, and a lot of people still know me and call me by that, or credit for short. You know, I spent years studying this stuff. I spent 2 years studying the credit scoring model with my own experiments, with my own tests where I did stuff for people's credit for free so that I could see what different changes and effects would have. And the thing about a foreclosure that's tough about it is that it's sort of like, it's the biggest FU you can give to a creditor is, I'm not going to pay yours.
I didn't even try.
Yeah, didn't try. We didn't work anything out. Just, yeah. So the credit scoring model reflects that and actually classifies a foreclosure as a Class 8 item. And
Class 8 or
Class 8.
8, okay.
Class 8. So, and then like a collection is Class 9, which is the worst. But the Class 8 foreclosure in the actual narrative foreclosure causes more damage to the credit than just like a Class 9 item like a collection.
Really?
The really tough part is that, so it hurts your credit score immensely for a very long period of time. It's going to be on your report.
7 years or so, or
10.
Yeah.
It'll be on your report for 10. But it can potentially not affect you after 7, but it will still show on the credit report. They say it doesn't affect the score after 7 years, but I've seen where it actually does. So it's one of those things you want to avoid. And today we're going to discuss several of the different options that you have if you're facing foreclosure, if you know someone who's facing a foreclosure. What do you do? How do you approach it? And then what are the options, essentially? Because we know for certain the foreclosure on your credit is going to be very damaging to the score, but also very damaging to your credit profile. Two things. Credit score, just a number. Credit profile, that's when a human being gets your loan application and sits there and looks at it, and they go, all right, what is this person's credit profile? How much money they make? What's on their report? So that profile also matters because you go to buy a house, they say, oh, foreclosure, okay, 4 years. Or, if it's FHA, maybe there's a 2-year exception or there's something else. But that right there is going to affect your profile, how you're viewed by creditors. So it's something to be avoided because pretty much everything else is better from a credit standpoint. So if we say that, so I guess the next closest thing, Jim, would be like a short sale.
Yeah. Yeah, exactly. Well, you've got a couple different options. I mean, well, I guess the closest to the foreclosure would be the short sale. And essentially, it's just to avoid the bank taking back the home because, like you mentioned, really no one wins in that foreclosure situation. The bank doesn't want to own the home. And so you can talk to a local real estate agent and say, I want to short sell my home. Let's begin the process. And you could probably go into a little bit more detail, but really it's not as much of a hit on your credit as a foreclosure would be. You get to typically stay in the home longer than you would if you were to go through a foreclosure. And even sometimes nowadays the banks are still paying relocation funds to you to help you with moving into a new place. Because again, the foreclosure just it doesn't work. You're not going to get any relocation funds from the bank. You're going to have literally goes to a sheriff's lockout a couple months after you get foreclosed on. So yeah, the short sale really is the route to go. Yeah,
if you have to choose between one or the other. I mean, in both cases, you're vacating the property.
Yeah.
The difference from a credit standpoint is on the short sale, it shows as settled for less, but it shows it as settled. So it's the same thing as like paying off an old collection. It says the same thing usually, settled, or settled in full, or settled for less, depending upon if you negotiate. The short sale is always settled for less, which is a negative narrative, but typically the actual account, the mortgage that's on there that was settled for less, will reflect the status that it last was in. Yeah. So if you were 60 days late, then it'll show as a class 3. If you were 30 days late, it'll show as class 2. So you can kind of control the actual damage that it does to your credit score and your credit profile, which is nice with the short sale. Have you seen more of these lately?
Yeah, we've seen an uptick, and we think it's due to really the loan modifications that happened roughly 5 years ago. Most loan mods have a 3 to 5 year period on them. When they reset your terms for a certain period of time, and then they go back to the original terms of the loan after that period is up. So if you say you had a 5 year period on a loan modification, we're in 2017 now, all those loan modifications that happened in 2012 are now coming back up. And the loan modification really is there to help the homeowner. If you're not able to make your mortgage payments, often it's because of a life situation, you lost your job, maybe it's some medical condition, that medical bills that came up. So that 5 year period is meant to really get you through that time. It'll lower your mortgage payment and help you get through those hard times. But yeah, we're seeing a little bit of an uptick in the foreclosure filings, and that's, we think, due to those loan modifications now reset.
Yeah, I think the intentions are good with the loan modification. It's sort of a punt. It's like, hey, let's talk about this later.
Yeah,
we know things
because again,
are tough for you now.
the bank doesn't want to own your home, so you miss mortgage payments. They're not right away saying, okay, yeah, we want to take your home back now. They don't want to. There's attorney fees associated with it.
It's an expensive process with a lot of liability attached to it. The loan modifications are something that people have actually done loan mods, and then at the end of that mod, done another mod.
Yeah.
And so we're seeing even some of those modifications that started in 08 or 09, where they got to stay, and then they're coming due here again soon.
Yeah.
So there's potentially more that could come from this. Another potential solution would be, filing for bankruptcy.
Yeah.
You can do a Chapter 7 or a Chapter 13.
Yeah, and in certain situations, the bankruptcy may even, you may even be able to settle the debt. It's very rare, but in the debt being the mortgage on the home, again, very rare, but it's worth at least trying. Again, we're talking about these solutions other than the foreclosure.
Right.
And so you've got the short sale, the loan modification, and the bankruptcy is really the third one. We work with a lot of bankruptcy attorneys that we could refer people to. And again, it's all these options to really avoid what no one wants, even the bank, is the foreclosure.
Yeah, and so with the bankruptcy, and something I'm really familiar with from the credit space, it's much less impactful on your credit than most people think. But more importantly, like if you're going to do a short sale, those loans could potentially have recourse. Now there's an act that's out there. I don't know if it's been continued or not. You have to consult an attorney, which we could refer you to. But it was forgiving all that debt. But you have to be careful. And if you're going to file a bankruptcy, you want to do it before you do a short sale, before you solidify the fact that you have a recourse debt attached to yourself. If you do the bankruptcy before you short sell the property or before they foreclose, then you at least don't have any liability associated, any recourse associated with the mortgage notes on any of those properties. If you want to stay in your home, a Chapter 13 bankruptcy could potentially allow you to do that as well. For people who are, facing foreclosure, maybe a Chapter 13 will work. You have to make money. That's a payment plan associated with the Chapter 13. It's a 5-year plan. It's a little bit harder to qualify for than the Chapter 7, which is, pretty much the worse your financial situation, the easier it is to qualify for a Chapter 7. Chapter 13, a little more complicated. You have to have income, you have to have the ability to repay, but just not enough ability to repay all of your debts. And then essentially the 13 says, okay, well, what can you pay? And then you pay that for 5 years, and then all your debt's forgiven. And that includes potentially upside downness on your home or arrears on your mortgage and things like that. So it is an option. So like if you're facing foreclosure, what we're telling you is don't foreclose. Whatever you do, do not let the bank foreclose on you. It is never going to work out good for you. It will never be good for you. It'll probably never be good for the bank either. And meanwhile, we have, you and I both know, really good real estate agents who can help with a short sale, really good bankruptcy attorneys who can help navigate the options involved in bankruptcy. Or if someone, and we see this a lot too, where it's someone who's in just a bad situation. Maybe it could be taxes are owed. And that's it. Maybe a home's free and clear, and there's an elderly person living in a home, and they get notices. They think, no, I own my home. They can't be auctioning my home off. Or, it's a situation where the house is in bad condition, but maybe it's free and clear, and they don't owe a mortgage, or they have a very small mortgage on it. And in those cases, still the bank doesn't want to foreclose. They have to give you the proceeds. A lot of people think if the bank forecloses that they get to keep the profits from the sale, which is not true.
Correct.
They still have to give it to the homeowner. So there's no big windfall for the banks, okay, when they foreclose on a home that you own free and clear. They don't want to do it. There's no profit in it for them. But you could still potentially maximize your profit if you were a homeowner and you're in that situation by just selling to a cash buyer.
Yeah. And that's what we do as investors. We work with a lot of real estate agents. But then there are those scenarios where you've got an auction date coming up in 3 or 4 days. And for whatever reason, perhaps you were just avoiding the situation, but now it's down to the wire. And really, it takes a cash buyer to come in and work a solution and really close something in a 2 or 3 day period. So, and of course, that's dependent on whether or not the homeowner has equity in the home. Otherwise, it would be a short sale. But yeah, we through our 7-day way program, 7dayway.com, you can go on, put your address in there. We'll get to you within 24 hours and just see what the current situation is and see if we can help you out. And the 7-day way, obviously, meaning we can close in 7 days or less. So again, it's going to be, every situation is going to be different, but if you're facing foreclosure and you're really down to the wire, give us a call and we can see if we can help you out.
Yeah, and it's 7dayway.com is the link that will be posted and attached to this video. But you're right, there's different degrees. There's the impending foreclosure, hey, we're not going to be able to make our mortgage payment this month, we're not going to be able to make it next month. Maybe if we get lucky, we'll be able to make it the month after that, but we're going to be 2 months behind. Now we're starting to think about what are some of our options, what are some of the things that we can do before our credit gets hurt too much.
Yeah.
That's like the very early stages. From that, all the way to, hey, they're coming to foreclose tomorrow, or they're coming to foreclose on Thursday.
Yeah.
And we have to figure out what to do between now and Thursday.
Yeah.
Yeah,
we've seen that a lot, and we get phone calls. And hey, yeah, we have the auction date coming up this week, and so yeah, we pretty much just need to put a contract in writing, get title ran on the property, and once that happens, we can close right away. And then oftentimes, though, most homeowners in that situation really are not ready to move out in a 2-day period, so we will work with the homeowner to allow them to stay in the house after the close of escrow, maybe work out some sort of rent for the time that they need to be in there. But we understand that there are certain situations that just come up, and again, all this is to avoid the foreclosure because, once again, no one wins, including the bank, in that foreclosure. So. And
what are some of the advantages, like for someone, a homeowner selling directly to an investor? I mean, because if someone were to say, well, let me just put this home on the market. I mean, obviously time is a big issue, but I think there's flexibility things there too.
I always suggest a homeowner talk to a real estate agent because agents serve a very important purpose in the market. They're going to put the house on the market, get the most for it. But when you come down to the wire, really oftentimes there is not time for an agent to put it on the market. And agents are going to charge a commission, so you'll have to pay that. Whereas with us, again, you're coming down to the wire, we're not going to be charging any commissions. We're going to be paying for the title and escrow fees, or what are known as the closing costs. So really it's a situation where we get in there and we give you a number, and that's the number you're going to get. That's the net offer price you're going to get, no additional fees associated with it. Because at that moment, when you're coming down to that week, your home is on the auction block, you need things to be as simple as possible. You need to know what you're getting and how long you're going to be able to stay in the home after you purchase it.
And I should mention too, as we said earlier, that the bank doesn't get to keep the profits from the sale of your home, but they are going to auction it. So will they really get a decent amount for it? So let's say you owe $100,000 to the bank. Your house, if it were fixed up, would be $500,000 house. But in its current condition, the bank's going to go auction it. They're going to get $275. Well, then the bank, after they subtract the fees from that $275, they have to give you the difference between that and the $100,000 you owe them. They do owe that to you. But if Jim and his crew, just as an example, come in and say, well, we'll give you $325 for it right now, then that extra 50 grand is literally directly into your pocket.
Yeah.
Directly.
In that scenario you mentioned where it sells to the investor at the auction, the only person that wins in that scenario is the investor that bought it at the auction. They bought it for much
Pennies on the
cheaper
dollar.
than I would have paid for it, because I'm going to be able to go in and look at your home and really see the condition. Whereas the investor at the auction, they're blind. They're not walking through your house. They don't know what condition it's in, so they're going to factor that in while they're bidding at the auction. And so, again, that investor is the only one that's going to win in that auction scenario.
Yes, and part of that is that they feel like they have to take a risk, which is really an unnecessary risk.
Yeah.
If you're in control of the situation yourself. So the point here is never let the bank foreclose on your home. 7dayway.com is where you can get access to the resources, including information about short sales, access to top real estate agents in the area. If you have time on your side, maybe a short sale makes sense for you. Maybe if you want to stay in your home, looking at bankruptcy is an option. All these things are offered through the 7dayway.com. And if bankruptcy isn't, if you're down to the wire, if it just seems like there's no other chance, then at least you can get a cash offer and look at what your options are.
Yeah, and let's not forget about the loan modification as well. That's
True.
an option for homeowners. That'll really allow them to stay in the home, because we understand that in this situation where you have a foreclosure coming up, it's not that you want to sell. You want to stay in the home, but you are on some hard times for one reason or the other. So that loan modification is another option that if you come to us, we can set you up with the right individuals to go through that loan modification process to see if you'll qualify, and that would ultimately allow you to stay in the home.
Whatever it is you're looking to do, stay in the home, make a smart financial decision, protect your credit, potentially even all of the above. 7dayway.com. Jim Ritter, thank you so much for coming
Derek,
today, man.
appreciate it.
Great to see you.